And welcome, everybody. If anybody wants to join, there are plenty of seats. Please come on up. Welcome, and thank you for joining us in this conversation about the gender gap no one is talking about, the gender gap in retirement investing. And I'm here with Sallie Krawcheck, who I will introduce properly soon, an expert in this topic and others related. I just want to take a minute to thank the Aspen Institute and The Atlantic for creating space for this conversation here at the Aspen Ideas Festival. I think it is an important conversation. I think it's one that all of us are interested in, and we certainly should be interested in it. It touches all of us. I think in the end, we are all after the same thing. We want to know that we can retire. We want to know that we are secure in having a place to live, that our health care is going to be covered, that maybe we can even enjoy ourselves, take a trip, maybe a trip to Aspen. We would need to save a lot in our retirement for that. But it's not clear that all of us can get there, and it's not clear that we can all get there at the same pace. I am Pamela Reeves, and just by way of quick introduction, I work with companies and foundations on investing in women. I advise Melinda Gates on global gender strategies, and I first became aware of the kind of work that Sallie is doing in gender lens investing when I was at the State Department when I worked with Hillary Clinton in the Secretary's Office of Global Women's Issues. So Sallie, thank you very much for joining us. Sallie Krawcheck is the CEO and co-founder of Elevest and the chair of the Elevate Network. She's going to tell us more about that and what it means in detail, but just in a sort of superficial lay way, let me tell you that they are, don't be mad at me for saying the wrong thing, just correct me later. In essence, gender-sensitive investment opportunities and platforms. Sallie devotes her time to encouraging women to connect and to collaborate across sectors to grow their businesses and to find ways to create and find new value and new ways to create value. I think that's fair to say. And she comes to this from the thick of it. Sallie spent years in the hyper male-dominated financial sector. I'm not sure I can name all the tremendous places you were at because they were terrific. Citi, Smith Barney, Merrill, and she won accolades along the way for the work she was doing and for the innovation she was able to make inside of those structures. And then you opted for a new path. And it seems to be working.
We'll see.
Well, your funds are oversubscribed as far as as far as my research shows. You've tapped into, it seems, a value proposition that motivates people in ways we haven't seen before. And I wonder, before we dig into retirement investing, whether you would go back and give us a little bit of a background, level set on the value you're creating in gender lens investing, how you are incentivizing people with your value proposition, and how does this why has this platform taken off, really? Like, what have we been missing?
Yeah. So Pamela, thank you, and it's such a pleasure to be here on such a beautiful day, and thank you all for taking the time to be here. So, as you mentioned, I spent my career on Wall Street, Smith Barney, Merrill Lynch, CFO, really in the thick of it for years and years. And if you'd asked me as recently as 5 or 6 years ago if I considered myself a feminist, I would have said, well, definitely, of course, but probably with a small f. It wasn't sort of this singular thing in my life, and I become a feminist with a big F because I've had along the way a couple of, I think, important insights. And so the one that really led me on this most recent path is one that I had one morning a handful of years ago when I was applying my mascara. And I'm sure, as you all understand, that's when a lot of the thoughts come out. And so I was sort of putting on the third coat one morning, and it struck me like a thunderbolt that the retirement savings crisis in this country, which is so big, $13–14 trillion in size for a savings gap, and the solutions to which are so nasty, tax increases, entitlement cuts, so we've essentially stopped talking about it because we can kick that can down the road. And it struck me almost in a way that physically hit me that the retirement savings crisis in this country is actually a woman's crisis. And that if you begin to recognize that, all the solutions change. Now, why is it a woman's crisis? Well, in part, it's because we women retire, we working women retire with 2/3 the money of men. That's because we don't earn as much. It's because we take more career breaks. It's because we don't invest as much. And we live 5, 6, 8 years longer than men. And so walk through any nursing home in this country, and it's 80 to 85% women. So I always want to make one thing perfectly clear. I love men. I've been married to a couple of them. I think they're fantastic. The truth is, you guys will be dead. And we will be left with this in the nursing homes. And so I know this can be sort of awkward, right, when we put these gender perspectives on things. Well, how can it be a woman's crisis? But if you begin to say that, then you say, wait a second, so how can we close this gap? Well, there's research out there that says that if we close the gender pay gap, we take women from that 88 cents to the dollar that men are making, we close the retirement savings gap by 1/3. The other thing that happens that instead of being a drag on the economy, as tax increases, entitlement cuts can be, it grows the economy, because if we've got the more money, in addition to investing more in the 401k and Social Security, that money goes into the economy, right? Likewise for the gender investing gap, which I'm particularly focused on now given my background, and that's what Ellevest is out to close. If we can close that gender investing gap, that actually can cost women more over the course of their lives than the gender pay gap. And that drives more capital into the markets, which also is a very good thing. And so as I began to sort of look at this framework, I thought, well, how can I spend I hope several decades I have left in my professional career, but two, and work to close the gender pay gap. And as part of that, I bought the old 85 Broads, which is a global professional women's network, renamed it Elevate Network. And there women come together to share ideas, tips, job opportunities, et cetera, on how to close that gap. And I founded Ellevest, which we did the big reveal on about probably 6 weeks ago, which is a digital investment platform for women, which is targeted toward doing something super different than what the investing industry does now. Now they say, women, you're not investing as hard as men, as much as men are, work harder. And this actually tries to rethink investing based on hundreds of hours of research with women for what it is that's actually keeping them back from investing. So I'm trying to hit this in several different ways because I think it's a win-win-win-win-win. Except that the idea that sometimes when we talk about these in a gendered way, it makes us feel uncomfortable.
So I want to actually ask you about some of the policy implications that you alluded to. But first, I wonder if you could, you talked about women live longer, they make less, there's different trajectories in the career path. Can you just walk us through a woman wakes up, the life cycle of a woman who wakes up at age 65 and says, oops, I have little or no retirement savings, how did I get here? And talk about the role of whether they're myths or realities, financial literacy for women, risk for women, and those pieces.
So it's I don't have a great answer. If you wake up at 65 and you say, oops, I didn't save for retirement, you got a problem. So you're going to have to work forever. It's a problem. And the challenge with investing is that it is so easy to put it off. I don't know about you, but I don't even like doing it, and it's where I spent my whole friggin' life. There's always something more interesting to do. But let me give you some numbers, which I think sort of frame this. So let's say that you're a young woman, you're in your late 20s, you're earning $85,000 a year, so you're doing well. You are doing what experts tell you. So if Susie Orman were here, she'd tell this young woman, you need to put aside 20% of your income so that you can have those big goals in life, one of which is retirement. And you put that money into the bank. And so you're earning less than 1%. By the time that so to back up, if you get the raise, so you're making $85K, you get the raise, so, but I'm I'm off track. So if you put the money in the bank, okay, you put the money in the bank, you're earning less than 1%. By the time you retire 40 years later, you've saved 1.5 million bucks. Okay? If you get the raise to what a guy makes, over that same period of time, you've earned another $1.1 million. If you take that money that you put in the bank and put it in a diversified portfolio, over that same period of time, you will have earned anywhere from another 1.5 to 2.5 to $3 million. So these differences that we're talking about are not incremental differences, they're huge differences. And here's the challenge. You're that same woman, and you know you should invest, but you want to go on a date with your boyfriend, but you want to go out with your friends, but you feel like you have to do some work in order to figure out how to do it. And you wait a decade to invest. 1 decade. And everybody does. So this is not outlandish. The amount of money that costs that young woman every day is $100 to wait a decade. And if I were to say to any of you, if you had a purse with a hole in it and $100 was falling out, you'd fix the purse. And so part of the challenge is, how do we imbue a sense of urgency about this? And what the woman is fighting is the stuff you just said. What she fights is that we've got myths around this that are more 1958 than 2016. It's that women aren't good at math. Well, that's not true. Girls make as good or better grades at math than the guys do. Women are not as good investors as men. Well, that's not true. In fact, the research shows that women are better or as good hedge fund investors, mutual fund investors, or individual investors as men are. That we need more financial education. This one is really hard to argue against because the numbers are clear. We do. So do men. But somehow the men invest through that and get the returns and the women don't. The other one, we're too risk averse to invest. It's the fact that we have uteruses or something somehow keep us from taking risk. Well, what our research shows is not that we're more risk averse, we're more risk aware. And that we want to understand more about the risk, not the standard deviation risk, but the how much money can I lose risk. And so all these myths sort of swirl around it, which leave this as the place where the guys are viewed as being better. And then my old industry, we were talking about this earlier, it's a male business. My financial advisors, when I was running Merrill and Smith Barney, were 85% male. And their age was high 50s, low 60s. It's a very male business. The jargon is male. It's a lot of war and sports analogies. Beat the market, outperform, pick a winner. The jargon, alpha, beta. Focus on the upside. When I ran Merrill, we spent, I could estimate, certainly hundreds of millions, maybe billions on upside, and mere single-digit millions on protecting downside. And then the final one is the symbol of the industry is a bull.
What's your point?
Get it? You know, guys look at that and like, yeah. Women looking like, it's not speaking to me. And so the whole industry just sort of feels set up for guys. And as a result, in my old businesses, a man would leave his male financial advisor if he didn't die, if either of them didn't die, at a rate of less than 2% a year. And a woman in the year after her husband's death would leave that same financial advisor at a rate of more than 70%. So something's broken, right? And as mentioned, it's costing women a fortune. It's costing women their financial sense of well-being.
So, Sallie, are you, in your own experience, are you saying that there's no room for change within the system with the bulls, and you had to go outside?
Yeah. So everybody's got a woman's initiative. Everybody's got a woman's initiative. And we had one of the different companies at which I worked. But they start from a place of how do we market to women? They don't start from a place of how do we serve women. And so they end up being newsletters and parties in which Chardonnay is served. And so it ends up, you sort of take a step back, and again, I spend my life in the industry, it tends to be a male's view of how women should invest. Let's get them together to talk about it and feed them some Chardonnay and some Brie. And every one of us have been to those like that before. And then I'll tell you my little anecdote. When I came to this recognition, I thought, I'm not an entrepreneur. I'm a big company gal, and I'm going to go into government or something. And so I'm not going to do this. But I'm going to, is sort of my gift to women and my gift to the big financial institutions. I'm going to go make everybody aware of this. And I'm going to go tell the big financial institutions that this market it's not like women don't have money. We control $5 trillion of investable assets. It's just sitting in the bank. So I'm going to go out and I'm going to talk to some of the guys about this. So I did. And went and had breakfast with one of them, who is not that old, and went through the opportunity, went through the numbers, 5 trillion, big gender investing gap, but women control $5 trillion of investable assets. 90% of women control their money on their own at some point in their lives. This is how I think we have to go about it. And he listened to me, and then when I paused, he said, yeah, that's so interesting, but don't their husbands manage their money for them? And you're not listening, but the truth is, what I've learned over time is we all come with our worldview. And so the worldview is from his view in a traditional marriage where, of course, he does manage their money for them, not in the way that the world is changing.
Interesting. So I want to ask you a clarification question and then something related to it. Where does the number 11 trillion in investable?
The Center for Talent Innovation put together a
That's
study
been out there, that number.
that says that women control on their own $5 trillion in the U.S. and control with their spouses another $6 trillion. And the other number to be aware of is that women should inherit 70% of the upcoming $40 trillion of wealth transfer that's going to occur over the next few decades. In addition to, our earnings level will increase likely more than men's as we start businesses at double the rate of men, as we go to graduate college at a rate of 60% versus guys at 40%, et cetera.
So you are describing a tremendous amount of power, right? That 11 trillion or however you count it, it's a lot of trillions and it's a tremendous amount of power. So I have a question for you about the way it works for shareholders. Why, or what is the advocacy play here? There's been a lot of talk about proxy votes lately and the power of the proxy, and what is the role that women should be playing, or maybe it's what you should be doing?
It's a great question, and my third business, which we didn't bring up, is the Pax Elevate Global Women's Index Fund, which invests in the top-rated companies for advancing women. With the idea that if you have more diversity in senior leadership, it should lead to better corporate performance and better stockholder performance. We're 2 years in, seems to be working. But in addition, to drive capital to companies that are embracing these values that we also embrace. So the truth is, if we women control this money, if it's sitting in the bank, it's not only not earning a return for us, it's also not having an impact in the world around it. And so the idea of values-based investing, impact investing, gender lens investing, any of it, the truth is, if you had come to me 5 years ago to my office, my big office at Merrill, and said, this is an important trend, it's the way people should invest, we can have an impact, I would have said, get out of my office, you friggin' tree hugger. I just thought it was stupid. I just thought, well, that's not what we do. We invest for the highest risk-adjusted return, and then we give the money away. And I've completely changed my mind about this, that for so many things, such as investing in companies that have greater gender diversity at the top, I think not only can you have an impact, but you can get that better return. And I think the research on this issue with gender diversity is awfully clear about these companies. And so why does saving the environment have to have a lower return? Why does doing the right thing for kids in Africa have to have the lower? I just don't think it does. And so the impact that we're missing is women are, according to my research, substantially more likely when they invest to consider their values. Traditional Wall Street today, whereas women, different studies say different things, but there's some studies that say the majority of women are interested in this. My personal favorite says something like 80% of women are interested in investing in companies that have more gender diverse leaderships. But there's other research that says less than 10% of financial advisors have even spoken to their clients about it. So it's something that if it's important to us, we have to bring it up. And I think it's a fast-growing and impactful trend.
And we've talked a lot this week about impact investing and different forms of it. And one thing that has come up and has not used the word gender-led investing, but is this ESG, environmental, social, and governance sensitive investing. And some people think that health should be, an H should be included. Is there a tension between the two? Is it sequential? Is it competitive? How do you, can you do ESG and also do gender lens?
Hell yeah. I mean, the market's huge for this stuff. You know, we talked about the assets that women control, but they're the assets that men control and institutions control. And so we're talking tens of trillions of dollars in the United States. Again, think about if we employ, and we're beginning to employ, some portion of this to these issues. You know, it doesn't have to be, oh, we can only save the environment or advance women, right? We can only have good governance or this value. No, not at all. To me, but you know, everybody should have the flavor of ice cream they're looking for. And these opportunities should be available.
Right. I guess my question is, can you have social and governance investing without women? Did you see what I'm saying? They seem to be next to each other.
I haven't been able to convince the bank regulators of that. I tried that. I went on a big kick because my other important moment was having been in the big banks during the financial crisis, and as I began to think through the underlying causes for it, the one that never, so greed, got it. But the one that never resonated with me was, oh, these evil geniuses on Wall Street tanked the economy. Like, I was there. That isn't what happened. But what really happened, in fact, if that is what happened, how come they didn't sell the stock of their companies? What I observed was groupthink on Wall Street. And that groupthink was driven and is driven by lack of diversity of thought, lack of questioning of each other. And so to my mind, Wall Street, which was non-diverse going into the crisis, was even less diverse coming out of the crisis. And so I began to have conversations with the regulators about, geez, you know, one way to prevent a crisis in the future is when you rank the banks on the, some of you here will be familiar with the Camel ratings, management is a rating. How about if we look at the statistics and say, more diverse management teams lead to lower risk? We could go that path, and I made exactly no progress.
But not for lack of trying. Yeah, I tried. So I want to go back specifically to the retirement issue and the way you've sort of laid out the trajectory. I come from government, and I'm interested in policy, and I hear you talking about things like long-term penalties for motherhood. Wow. I mean, those are the way I would, you know, those are my words that I would do it. I'm curious about what the interaction is, what's the interplay, what's the relationship, what can you do or what should you not do, or where does it, how do you move the ball forward on solving for the problems that may be in the government's?
Yeah. So let's start off with, I'm certain everybody here knows that we are the only developed country in the world without a mandated maternal and parental leave. It's astonishing to me that we don't have it. And when you go to the private sector, there's statistics that say that less than 20% of companies in this country have parental leave policies, maternal leave policies. Now, I have 2 kids, and I'm telling you, I speak from experience when I say it takes a while to recover from birth. It hurts. You got to recover. You got to get the kid on the path. And thank goodness that I worked at a company where I had the time off to be able to do that. I cannot imagine what it's like to have to go back days after having had a child. As a result of this, companies lose. And so there's a flawed way of thinking that parental leaves and maternal leaves cost companies money. In fact, they save companies money, and they save companies money within the first year. Yes, there is an investment in that parental leave, but the return comes when the woman is more likely to return to work. And so the company does not have to find a replacement for her, which is expensive to find and expensive to train. And so I'm slightly hopeful because there's new research that's come out from Vodafone commissioned it. I think it was KPMG that did it, that says that big companies can save money in the first year of having a parental leave, and that they can save something like $19 billion if they institute one. So I think that's the first step, is having a leave for these individuals is actually a very good thing for the economy and for companies. And the second thing is this bias that we've got, that when women are on these leaves, they are not then investing into 401k, and they're not putting money into Social Security. And it leaves them fundamentally at a true disadvantage when it comes to men. It's simply just not fair.
And the private sector is leading in this. Are you hopeful that there will be national policy, or is it going to be up to you?
You know this better than I do. I mean, I'm happy to say that while we aren't talking about the retirement savings crisis as much as I would wish, we are beginning to talk about the parental leave to a much greater degree. And so I think we can all guess which candidate would be more likely to execute upon something like that. But I have the beginning glimmerings of hope. But again, you know better than I do. There's saying and then there's doing when it comes to government policy.
It's interesting. I don't know what candidate you're talking about, by the way. So let's go back to a big question for you as Sallie Krawcheck. You have had tremendous gains. You've really done what other people would have said was the impossible. And I'm curious if you can answer the question from your perspective: what do shareholders look for in leadership? Because you are leading and you're doing a great job.
Well, you're kind. I appreciate that. Probably not enough is the answer. You know, when I was CFO of Citi, nicely before the crisis, but I don't think it's changed any. But the shareholders drove the company into the crisis. And there was a moment for me that I will never, ever, ever forget, when the CEO of the company went into a meeting with shareholders, and they were not hedge funds. They were supposedly long-term mutual funds, and this is pre-crisis, and one of the mutual fund portfolio managers asked the CEO what the growth rate of Citi was that he was looking to drive. And this is the time Citi was the largest bank in the universe. And the answer that came back to the gentleman was 9%, 10%, something like that, which of course is multiples of GDP growth, right? So we can debate how long that can be sustained. We found out the answer. But this answer was given back, and the portfolio manager listened to the answer and then did this, which I was astonished because my mother taught me not to do that. But in fact, I'm going to give, this is the only thing you're going to remember from this talk, okay? If there's only one thing to know about whether a couple is going to get divorced, it's whether they do this to each other. If they do this, they're going to get divorced. It's a sign of contempt. And contempt is completely poisonous. Research is clear here. So this guy did this to the CEO, which meant that growth rate isn't enough. We need more growth. Now, this was right after Phil Purcell was driven out of Morgan Stanley for not growing the company enough, for not being big enough in the subprime business. Lost his job. So we left that meeting, and the CEO turned to me and said, we got to deliver more growth. We need to leverage the company up, right? And he wasn't a hedge fund manager. And what he was looking for, because he was invested in the company on average months, not years, was fast growth. And for him, pushing for growth was always the better decision than to work against the downside, because you're more likely, the stock, you got more upside than you do downside on any given day. And so I'm not a CFO any longer, thank goodness. I don't engage directly with shareholders, but I don't have enormous reason to believe that they've gotten any longer term in their perspective. In fact, I was reading today the stress tests have come out, and shareholders were talking about the shareholder-friendly increase in dividends and share buyback. And I thought, I don't know, I've seen the movie before that when banks were doing that before the crisis, it wasn't so shareholder friendly. It was quite shareholder unfriendly, as a matter of fact. And I don't know how we've gotten sort of confused with the idea of more capital at companies is always a bad thing.
So interesting. We actually have time for questions, and we've got a microphone here. If any, we're not going to be able to hear you unless you use the microphone. So if you don't mind coming up. Yeah. Are we lining up? Is that the best way to do it? Lining up is the best way to do it. Thanks.
The question has to do with the returns on equity and the performance of companies that have more women on boards, more women in the C-suite, and if that data, which has been public and is continuing to be more data developed, it sounded to me as if you could share some of that data, and it also sounded to me that the banks aren't believing it.
No. So I think the research has now gotten to the point of being overwhelming, which is that greater diversity in leadership teams, and in this case in particular greater gender diversity, is coincident with, correlates with, whatever word you want to use, but exist alongside higher returns on equity, not by a little bit, by double-digit percents, lower risk, lower volatility, a greater long-term focus, a greater client focus, greater employee engagement, greater innovation. In fact, that the power of diversity is so great that diverse teams outperform smarter and more capable teams. That was the one for me. When Eileen Lang at Catalyst shared that with me, having grown up on Wall Street, which worships the almighty brain, and said, wait a second, diversity can outperform intelligence, and began to think about, yeah, I guess if, it's 6 math PhDs who all went to Ivy League colleges, who all were in the same training program, who all vacation together, and you add one more, you're not adding anything, but you add a marketing expert, you add something. And so that's when it began to make sense to me. So the research is out there. My experience with why people aren't just running towards it is because it forces us to imagine a different path. So the company is doing quite well now. It has a 15% return on equity. Well, gosh, if we had a bunch of women in there, it'd be 18% or 20%. I mean, it just doesn't calculate. You don't know that other path for sure. And I also found that everybody is in favor of diversity in theory. And then, when you're at work and it's between this person who's nothing like you, who you really as a manager have to struggle to understand, who says things that make you uncomfortable, who looks different from you, and someone who's like you, right? When, I always find myself, she's the best. She's a middle-aged, bottle blonde, financial services background, Southern female. I really like her. And then I'm like, oh my gosh, that's me. I like her because she's me. And so what I saw happen about 1 million times is that in theory, diversity is important, but in actuality, when it comes down to it, particularly when you're in a crisis, all of a sudden, I need to have Joe because I need someone I can trust. And so you put that person in, and the reality unfolds, and the idea that you might have done better if you'd had somebody diverse and different just doesn't come into play.
And if I can just add, so first of all, some of the research that she's referring to is by Catalyst. So if you're not familiar with them, you should really check out what they've produced. But one of the issues that we're also talking about here is pipeline, right? All the things that you were working on would change dramatically in a number of years if we could fix that pipeline. And there are, for those of you who invest or who run businesses, the idea of promoting women, of bringing them back in after maternity leave, whatever the issue that keeps them, continues to educate them, and promotes them, is something that seems obvious and not so dramatic, but it is dramatic and it's not getting done. And
it's pipeline at the middle levels. I got a call from, I think it was the New York Times 3 years ago, and they said, Sallie, this is so interesting. We want you to comment on it. The investment banking class this year is a third women, so we're starting to fix this. And I said, well, you know what? I started as an investment banker in 1987. You know what my analyst class proportion of women was? A third. And so we're losing women. We tend to lose women in their 30s and their 40s. They're okay in their 20s. And so it's that point. And to your point, if they take a maternity leave, bringing them back, keeping them involved along the way, and then bringing them back will go a long way.
Yeah.
Yes, sir.
Yes, I've been an investment advisor now for 35 years, and I learned a lot of things from you today, and I appreciate what you're doing. I wanted to ask you a question about a couple of macro trends that I see in the investment industry and what impact it's having on the issues you're addressing. The first is that after the tech bubble popped, the entire industry became quite risk averse. Never writing another check to another jerk was what Paul Purcell, Phil's brother, told me at my firm as being the new goal of the firm. So the whole idea of investing in the kinds of things that you accurately claim are necessary to big wealth over time, it seems as though the entire industry is moving the other way. The other thing, in terms of enabling people to save for retirement, is the fact that since the business has now become wealth management instead of financial advising, the message is you get wealthy first and then come see us, and no one is interested in helping people make money anymore. They're interested in not losing it all at once they already have it, but it seems to me for people who are trying to build retirement, that's not all that helpful. So I wanted to get your feedback on that.
So for those of you who are not in the industry, excuse us for a second because we're going to talk shop for a second, and then we'll come back. I think the biggest mistake the industry made was a handful of years ago, exactly what you said, which is we're just going to go after people with $250,000 above in wealth. Well, the truth is those people have already got financial advisors. And so what's happened in the industry, Merrill Lynch, Morgan Stanley, UBS, not as much Baird, but the crew, is they're just stealing clients from each other. And they're paying a lot of money to do it. The other challenge with the industry is they're stealing financial advisors from each other, and they're not training individuals. And so I've put in probably more financial advisor training programs than anybody and had more of them wiped out later because it's expensive to train folks. It takes 8 years to earn a return on a new financial advisor, and you always have a bad market in 8 years, and so you always wipe them out in order to make your quarterly earnings. So much of the innovation is going on in the space that I'm now in, which is the digital investment platform space. And look, it's what young people are looking for. We'll always have people engaging with people, but what is so friggin' interesting about Ellevest right now, and we are such early days, but remember, when I went into it, women, the other myth, women need hand-holding. Women must have a personal relationship. Everybody told me it. Well, you know what's interesting? When you take away a lot of the complexity and the jargon and put in women's hand the things they can control. What do you want to achieve in life? You want to start a business in 8 years. You want to retire well. How much money do you have? And then you help them get there without making them pick this ETF versus this mutual fund, but you provide that advice to them. They're making it through without a person. And do you know when our website is the busiest? 9 o'clock at night. And what we're seeing is women are coming on, and this is where I will admit the guys have been right a bit, because I suspect a lot of them do have the Chardonnay in their hand. And what they're doing is they're planning, right? I'll start the business later. I want to retire like this. I want to buy a house. And we're finding that they are much more amenable to an online-only experience than I ever imagined when I was in the traditional industry.
Hi. Is it on?
Yeah.
Okay. So you have just struck a chord in me as the middle-aged woman with a 23-year-old daughter. And so I think one of the pipelines that really needs to be addressed is nothing is going to change unless we're having the conversation at the very beginning of their life cycle pipeline. So what do I go tell my daughter, and you all tell your daughters and granddaughters?
Yeah, it's what we tell them and what we tell other people. And it's, I think, more important than what we tell them, what we model for them. So my new shtick is, you know, we all spend all this time asking ourselves these questions about work-life balance, we as women, and we torture ourselves over it. And I've never had work-life balance. I've had work and I've had life, and sometimes one has been more and sometimes one has been the other. But I don't know that my daughter, given the changes in the economy, will have the luxury of the work-life balance. I think she's gonna have to work her whole life. And so my question has been more, what am I modeling for her? You know, what is she seeing me do day to day? Is she seeing a guilt-ridden mother who says she wishes she were at home? Or is she seeing a mother who's loving her job, loving her life, you know, out there every day and coming and bringing some of that home? Because that will help her, to my view, get through the pipeline if she's got that modeled. But if what she had modeled is, I hate it every day, I feel guilty, I was 15 minutes late for the kindergarten play and I'm gonna slit my wrist, you know, then she's taking away, there's a guilty bad thing about it. So I actually feel pretty strongly that we need to shift this conversation away from the guilt and more to the joy. Yes?
Making sure that our daughters and granddaughters are becoming liable for their own financial situation as opposed to just having their dad do it.
No doubt about it. And this is where I also think we need to model this for our kids. So I'll use an analogy. I did not exercise until about 5 years ago. And I sort of refused because I hated that society expected me to. You know, and by the way, what are Spanx for if not to pull it all in anyway? So I sort of refused, and then I realized that I had set that example for my kids. And the idea of we have high cholesterol in my family, the idea that my kids wouldn't exercise and would die sooner because they hadn't seen me do it. It's one thing to tell them to do it, but if I don't do it, they're not going to do it. And the same for investing. That if they see us as women in control of our money and investing, then it becomes a natural part of their lives. If we're outsourcing it to their dads, then they're not going to see it that way. The other point I want to make, the conversations. I think conversations it's a super important topic. And I've started to give a lot of thought to the courageous conversation that all of us can have. So what's that? Well, Sheryl Sandberg certainly had a courageous conversation with Lean In. But what the research shows is that if we have smaller conversations at work, they can begin to have an impact. And so it can be, hey, you know, I just saw you interrupt that woman 4 times in the meeting and you never interrupted the guys. You know, quiet word. Or, hey, I know we've all probably familiar with the research that if I advocate for another woman in the business, you're going to think it's because I'm a woman and discount it. But here's why I'm advocating. Or, hey, and this happened to me, we just promoted a guy who we called aggressive and ambitious, but we used the same words for a woman and then we got her an executive coach and didn't promote her. And so beginning to have these very fact-based, not accusing conversations at work are the seeds that we can plant for our daughters so that when they come through, all of us are more aware of what's going on. I think it's really, really important. And it's been shown to have a real impact, one conversation at a time.
Well, I think there are no other questions, I hope, because we're out of time. But Sallie, I can't thank you enough for sharing your wisdom with us, your insights, and I think we've learned a lot. I think my husband has learned a lot, so I thank you.
Good. You.
So,
Thank
Sallie
you.
Krawcheck.